Hour, and the market has tried to sustain some of that momentum, still above 19,300, and the mid-cap index is up about 0.5%. That's Nifty up about a quarter. Nilesh Shetty, portfolio manager at Quantum Advisors, is now with us. Nilesh, good to have you on the show. Hope you've had a good weekend. So, just tell us how you are looking at the market now in terms of the next key triggers or the next key factors. A lot of the global headlines on interest rates, they've been dominating mind space. The earnings season is behind us. What next really for this market that continues to be so range-bound?
Yeah, and fortunately for India, interest rates are not at a level that is uncomfortable for us. We are just back to pre-COVID levels. And despite the recent rise in inflation, it looks like it is transitory in nature. There is no major or substantial increase in interest rates forecasted for India. So in that environment, at least the companies that we are interacting with continue to suggest that the environment, at least macro environment, remains comfortable. As long as demand picks up and they hit a certain threshold of capacity utilization, you will see new capex come through. Relative to the rest of the world, India right now is very sort of well placed strategically, especially in a world where large foreign investors may not be able to allocate more to China, given the way geopolitics is played out. So at least on the macro front, it looks a lot comfortable for India. No major concerns. And the earnings numbers are coming through, which are very broad-based earnings recovery that we are seeing in India. So at least for the next 2-3 years, we are not seeing any major concerns on corporate earnings. But the only place that worries us when we are looking at the market is what is happening in the small and mid-cap space, where it looks like some level of froth is building up. Being an allocator, we know when we try to buy into even sometimes large caps, liquidity is just not available in the Indian market, and there is significant impact costs. So in the small caps, when you're trying to allocate money, the price impact is very large when you're buying up. And when you want to exit, it becomes extremely tough because there's no buyers there. So one hopes there is no event which forces reversal of liquidity there, because the correction can be very sharp. But barring that, there is no major sort of macro risk for corporate earnings in India.
Nilesh, thanks a lot for joining us. You know, we've been speaking to so many fund managers, and in addition to liquidity not being available, it's also just that valuations have run up so much in some of these pockets of the mid and small caps that it's just becoming hard to look for any opportunities. But do you think there's anything within this space, any smaller pockets that you feel still offer a good opportunity even at these levels? Because there are definitely pockets, railways, defense, all of that, which has run up like crazy.
Yes, some of them is a lot more based on hype. I think some themes catch people's fancy and then the rest of the market just follows, assuming there is momentum built up there. But especially in sort of the larger liquid names where the rally is not been that sharp, you find selective names. So for us, we've added a building materials company in the portfolio. We've added a private bank in the portfolio, which has had significant underperformance. Consumer durables, which were extremely expensive till 2 years ago, have seen a significant de-rating. And you added a consumer durable company in a portfolio. So selectively, you will get names coming through. But again, at a larger cap level or liquid large cap, we are not that worried about valuations. It's more in the small cap space that looks like froth is building up.
What about the new age tech companies? Companies are taking big steps to try and improve their profitability. Today, there is news on Zomato that how over the last few days, they are trying to incorporate a platform fee of 2 rupees per order. And if that sustains, it can be a big boost to the company's profitability going ahead. Notwithstanding the supply pressure that Zomato is going to face in this week, what's your view on these new age tech companies, the valuations and their path to profitability and the steps that they're taking?
They have corrected significantly from sort of their heydays, and valuations from those levels have come off quite dramatically. But even today, based on current valuations, you have to make fairly optimistic assumptions on cash flow generation for you to justify current market cap. It's a space that we are watching very closely because we are value buyers. Sharp correction sort of hits our radar into what is happening in these stocks. But even for us, there is some way to go for them to be really attractive to add to the portfolio. Like I said, you still have to make fairly optimistic assumptions on cash flows, where the company themselves are trying to figure out how to generate profitability. And most of that already seems to be in the price. So there is not that great a margin of safety. So, but it's a space we are watching closely.
Okay. Nilesh, just to go back to the point that you made earlier, that the only area of concern for you really is the run-up in mid and small caps. You mentioned that there's some froth. Can you drill it down, at least some broad sectors or themes where you actually see this building up more than others?
Yeah, unfortunately, small caps, by and large, is primarily driven by flows. So you look at the kind of flows that have come into retail small cap funds, and you look at the number of stocks that these funds are holding, and you look at the daily liquidity of those stocks. I'm not sure how the fund manager will eventually exit these names when he wants to, if there is a liquidity pressure. And some of these funds are holding 180 names, 170 names. And the reason for that is even at very, very small allocation at say 0.5% or 1% of the fund's size, they are already 5-6% of the company's outstanding share capital. So it is just a broad-based liquidity rally, which is taking up the small caps, which is fine when the companies, the liquidity is coming in. But in case of a reversal, the impact can be very, very severe. And we've seen that in 2018, the small cap index was down 30% in a period of 6 to 8 months when people are trying to take money out. Fortunately for the market, so there's been another rally which has taken the small caps even higher.
Yes.
But it doesn't look like it's driven by fundamentals as such. It's just money coming in and they're forced to allocate in that bucket given the rules that SEBI has laid out. And right now they're just allocating where they can.
Okay, Nilesh, got that, and thank you very much for joining us. As always, it's great to have you on the show, and we do hope to speak with you soon, once again. But with that, we're going to get into a short break. The market is